Hello, investors! When you first begin, investing can seem intimidating, but it is a crucial step in building wealth and setting money aside for a range of financial goals. In this video, I'll go over what I believe are the best and safest investment types for beginners. First on the list is gold. The idea of trading gold coins may come to mind when someone suggests investing in gold. Investors may still purchase gold coins in bars, but there are now a wide variety of choices available. Gold exchange-traded funds, certificates, and futures contracts are available for investors. Due to the widespread usage of gold in sectors like fashion and technology, investors like being able to readily exchange their holdings in a market with universal demand. Additionally, many people find psychological comfort in owning a tangible object whose worth is linked to its physical shape. Gold gives investors the option to diversify their holdings, but they should be aware that maintaining tangible assets like gold and jewelry requires money. Investors should also be aware of the fact that buying gold may be expensive, and that the only way to benefit from it is by appreciation. Bonds. Bonds are a financial tool that the federal government and businesses employ to solicit funds from the general population. In exchange for their money, bond buyers are promised interest payments over a predetermined period of time. Bonds are regarded as low-risk investments since they reflect debt that must be paid back over a specific period of time. Investors may also decide the precise gains they will make thanks to the specified maturity date and interest rate. These advantages do not, however, come without costs. For instance, because bonds yields are affected by inflation, they are known to offer weaker profits when compared to other assets, like real estate. Bond maturities can also run up to 30 years, which makes it a long wait for investors hoping for quick returns. Individual stocks. Stocks is the term used to describe shares of corporations that the general public can buy. Depending on how the economy and company performance are doing, the value of these stocks rises or falls. Investors in stocks might make money by selling their equities at higher prices or by getting dividend payments from business earnings. The freedom that the stock market provides is appreciated by many investors. While some choose a passive strategy and hang on to their assets for a long term, others aggressively trade their shares on the market. Stockholders, however, are exposed to the market volatility-related risks. Even on a daily basis, economic swings can lead stock values to skyrocket and fall. In order to see profits over the long term, investors must be ready to deal with this irregularity. If you're finding this content helpful, please like, share, and subscribe. Mutual funds. A mutual fund is an investment firm that collects funds from several investors and combines them into a sizable pot. The money is invested by the fund's qualified management in a variety of assets, such as stocks, bonds, commodities, and even real estate. Shares of the mutual fund are bought by an investor. A stake in some of the assets controlled by the fund is represented by these shares. Because of their fee structures, mutual funds are not meant to be exchanged regularly and are intended for longer-term investors. Due to their extensive diversification, mutual funds are frequently appealing to investors. Diversification reduces the risk associated with an investment. Mutual funds provide a single, all-encompassing investment vehicle, eliminating the need to do independent research and make separate decisions for each type of asset to include in a portfolio. Many mutual funds may have thousands of different assets. Dividend stocks. Dividend stocks can offer both the growth of individual stocks and stock funds, as well as the stable income of bonds. Regular financial distributions to stockholders, known as dividends, are frequently connected to stable, successful businesses. The payouts and stability that some dividend stocks offer might make them appealing to investors, even if their share prices may not climb as high or rapidly as those of growth-stage businesses. Always keep in mind that dividends from taxable brokerage accounts are taxed in the year they are received. Alternatively, Stocks, which do not pay dividends, are subject to primary taxation upon sale. Young investors, for instance, should be well advised to evaluate dividend growers, which are companies with an established track record of continually raising their payouts. These businesses may not currently have high yields, but if their dividend growth continues, they may in the future. This can produce returns that are similar to those of growth stocks that don't pay dividends over a long period of time. S&P Index Fund. The S&P 500 Index Fund is an excellent substitute if you wish to obtain larger returns than more conventional banking products or bonds. The fund is centered on around 500 of the biggest American corporations, which includes many of the most prosperous global businesses. The S&P 500 Index Fund provides immediate diversification by letting you hold a portion of each of those firms. Since the fund holds businesses from many sectors of the economy, it is more durable than many other investments. The index returns have averaged 10% yearly growth throughout time. These funds are among the top index funds and may be bought with relatively low expense ratios. 401k. A retirement savings account, known as a 401k, allows an employee to invest a percentage of their pay in long-term assets. Up to a certain amount, the company may match the employee's contribution. 401k plans are defined contribution arrangements. This means that the performance of the investments and plan contributions both affect the sum that is currently accessible in the account. The employee is required to contribute to it. The employer has the option of matching all or a portion of that contribution. In a conventional 401k, the investment gains are not taxed until the employee takes the money out. This often occurs after retirement, when the individual has full control over the funds in the account. Certificates of deposit. A certificate of deposit is a sort of savings instrument that, for a specific period of time, earns interest on a single sum of money. For CDs to avoid fees and lost interest, the money must stay in place over the whole term, unlike savings accounts. Savings accounts frequently pay lower interest rates than CDs to make up for liquidity loss. Finding the best CD rates requires comparison shopping because there is a startling variety offered by various financial institutions. For instance, even long-term CDs from your local bank may only pay a small amount, but those from an internet bank or local credit union may pay 3 to 5 times the national average. One of the CD's drawbacks might potentially be a benefit for certain people. The set time period of a CD and the related penalty for early withdrawal serves as a barrier to spending for people who believe they won't have the self-control to refrain from spending. High-yield savings account. High-yield savings accounts are a special kind of savings account that generally pay 20 to 25 times more than the average national rate on a conventional savings account. People have often kept their savings account at the same financial institution where they keep their checking accounts, making transfers between the two simple and swift. A new type of high-yield savings account has been introduced as a result of the emergence of internet-only banks and established banks that have extended their doors to clients nationwide via online account creation. The rise in earnings is substantial when compared to the national average rate for high-yield savings accounts. If, for example, you had $5,000 in savings, and the national average annual percentage yield was 0.10%, your return would be just $5. In contrast, if you invested the same $5,000 in a 2% earning account, you would make $100. You might need to keep your checking account at one financial institution and your savings account at another if you make much more money. Although switching money between your checking account at Bank A and your savings account at Bank B might seem awkward at first if you're used to having both accounts at the same bank, today's electronic transfers between institutions are readily available, and the speed at which those transfers can be carried out make this a relatively simple process. Before investing money in an investment, be careful to think about your risk tolerance and your financial objectives. Some investments, such as high-yield savings accounts, permit easy money access in case of emergency. In the meanwhile, stocks should undoubtedly be included in a long-term investing strategy. If you like this type of content, please like and subscribe to the channel for more information on investing and finance.